There's one thing a 55-year-old man would pay anything for. You have it for free. You just can't feel it. Time. You probably think the biggest financial risk after 30 is that you haven't saved enough yet. No. The real risk is that your 30s are the most valuable decade your money will ever have. And there's a line forming behind that decade. Entire industries have rebuilt their products to reach into it right now while it's worth the most. I'm going to show you 5 traps from that line. Picture this. Evening, you're watching the game. 43rd minute, your phone buzzes. Bet on the next goal. Boosted odds right now. You tap the button. The casino doesn't wait for you in Vegas anymore. They put one in every man's pocket and taught it to text first. Online betting is almost $90 billion a year worldwide, and roughly 80% of it moves through phones. The biggest market, by the way, isn't America, it's Europe. Economists at America's National Bureau of Economic Research ran the numbers. Legalize online betting and personal bankruptcies rise 25 to 30%. Young men take the hardest hit. This trap has a twin in a nicer suit, trading. The app feels like a game. One swipe and you've bought an option. But the biggest free brokerage apps in the United States run on a bookmaker's business model. They sell your order flow and get paid on every trade you make, whether you win or get wiped out. That's not a conspiracy theory. It's written in their own filings to the United States financial regulator. The results have been measured, honestly. About 1% of active traders stay in the green. Economists Brad Barber and Terence Odeon proved it a quarter century ago. The more you trade, the more you lose. That's real, documented data. Remember one thing, the bookmaker gets paid when you bet. The broker gets paid when you trade. Nobody gets paid when you win. So at this table, you're not the player, you're the product. The second trap arrives on the best day of the year, raise day. Here's what nobody tells you about a raise. You're not the only one who sees it. The bank sees it and sends you a pre-approved loan. The car maker sees it and its ads start explaining that you've earned it. The industry knows the exact moment a man can be sold a more expensive life. Then comes quiet lifestyle inflation. Income up, spending up to match, and the difference that was supposed to become capital never arrives. This trap's flagship is a new car on credit. Anywhere in the world, it loses about 20% the moment it leaves the dealership, and around 50% in 3 years. And the loan outlives the car. In the United States, the average auto loan stretches almost 6 years. 1 in 5 runs 7 years or more. The debt melts slower than the metal. That's why nearly a third of Americans trading in a car owe more on the old one than it's worth, $7,000 more on average. And that hole gets politely rolled into the next loan. Think it's a willpower thing? In the United States, 40% of households making $500,000 a year live paycheck to paycheck. Spending catches up with any income. Bottom line, you barely see the raise. It got spent for you by the marketers and by the pressure to keep up. So far, this looks like a list of expensive but enjoyable habits. But look at the math I actually made this video for. Over the long run, the global stock market averages about 7% a year. At 7%, money doubles roughly every 10 years. $1 invested at 32 is $2 at 42, 4 at 52, 8 by 62, 3 doublings. Now think about it. Every 100 they take from you in your early 30s isn't 100. It's $800 pulled out of your 60s. An extra $300 a month for the status car isn't $3,600 a year. It's nearly $30,000 out of your future. And here's the real answer to why the line formed behind 30-year-olds. A 50-year-old's money won't have time to double even once. There's not much to take from him. Yours will double 3 times. The industries know this math by heart. Now you know it too. The third trap is the only one where they shake your hand and say, congratulations, the house. The purchase itself isn't the trap. The size is. Look at who's sitting at the closing table. The bank earns interest. The bigger the loan, the bigger its revenue. So you'll get approved for noticeably more than what's safe. And the brain reads you're approved as you can afford it. In most countries, the agent takes a percentage of the price. The person helping you choose earns more when you spend more. It's like packing a backpack for a 30-year hike with helpers who all get paid by the weight of your pack. The safety line has been known for ages. Housing, up to roughly 30% of your income. Above that starts what people call house poor. There's a house and no money left to live on. In the United States, the average home already costs the median family about 38% of its income. And according to Harvard's housing researchers, 1 in 4 homeowners is overloaded with payments, a 15-year high. Everyone at that table made money by making the number bigger. Only one person signed up to carry it for 30 years, you. The fourth trap is the politest one. It looks like caring. In your banking app, under your credit card balance, lives a soft little button, minimum payment. Looks like a life raft for a hard month. Now the card's own arithmetic. $6,500 of debt at 22%, a normal American rate, but the math is the same on any card in the world. You pay the minimum, about 2% of the balance a month. That's it. You're in this debt for roughly 18 years, and you'll pay back more than $14,000, over twice what you borrowed. The minimum payment isn't designed to make things easier for you. It's designed to keep you paying as long as possible. That number is small on purpose. The scale matches. Americans' credit card debt, according to the Federal Reserve, has passed $1.25 trillion. And one cardholder in 10 admits they can only manage the minimum. And here it is, the fifth, the most expensive trap of all. It's your salary. Economist Linda Babcock at Carnegie Mellon University did the math. By not negotiating your starting salary, you leave $1 to $1.5 million on the table over a career. Almost every raise is a percentage of your current number, and your next employer anchors to it too. Except $6,000 a year less at 30, and that gap rides with you for 40 years. And by researchers' estimates, it grows to nearly 900,000. Here's the insulting part. Everyone knows these rules. In surveys in the United States, about 70% of hiring managers expect the candidate to negotiate. But the candidate stays quiet because the salary range was hidden from him, and asking for more feels like risking the offer. That secrecy was such a convenient lever that they've started banning it by law. In the European Union from 2026, companies must disclose salary ranges. A secret that has to be banned by law isn't a tradition, it's somebody's profit. They hid the number and bet on your politeness. That politeness didn't cost you $5,000. Over 40 years, it grew into the price of a house. So what do you do with all of this? No courses, no gurus, one evening. Take your fixed monthly payments, housing, loans, insurance, subscriptions, everything that charges itself. Add them up and divide by your take-home pay. If you're at 55% or higher, you don't have a discipline problem. You have a structural one. At least one line on that list has to die. Pick one and start unwinding it this week. Plus 2 quick wins, an automatic transfer into a cheap index fund on payday, before lifestyle inflation ever sees the money. And if you're carrying a credit card balance, pay above the minimum. The minimum is where they earn and you lose. The whole difference between a man at 50 and a man at 30 is 3 doublings of compound growth. He's out of them. You still have yours, and now you can see your leverage. Use it. I break down the money machines and hidden traps running under everyday life. If you're into that, hit like and subscribe.